Thank you so much, all of you, for coming here today. My name is Leif Haase, and I direct the California program of the New America Foundation, which is a nonpartisan think tank based in Washington, D.C. and in Sacramento. And I wanted to join Olivia in welcoming you all here today to the third in the series of working lunches on California asset policies, co-sponsored with APIC, the Asset Policy Initiative of California. We're committed to working across both sides of the aisle to seek solutions that will make it easier for low-income and middle-income Californians to build the wealth they need to weather financial crises and to plan for a secure retirement. We want to thank everyone in the legislature and the staffs of both organizations who've helped us to put together these events. Homeownership is the linchpin of most families' strategies to build and maintain assets. And as you probably know, California has one of the lowest rates of homeownership of any state in the union. That's one of the things that makes the current wave of foreclosures in California, most of them in the subprime market, so important and so discouraging. We're delighted to have with us today Paul Leonard of the Center for Responsible Lending, one of the nation's leading experts on lending issues in low-income households, to discuss this crisis and possible policy responses. Whether one agrees or disagrees with Paul on the right things to do now, his thinking and writing is at the heart of the debate on the subprime crisis here in California and in Washington. We're proud at New America to offer him a platform to present his views, and I'd like to call on Ben Mangan, the President and CEO of APIC and EARN, to introduce Paul Leonard.
I want to echo the welcome that's already been extended. I'm going to say a few words about APIC and EARN. We're a nonprofit organization that's committed to the practice and the policy of asset building to help break the cycle of poverty for low-wealth families and to create new cycles of prosperity. We have a nonpartisan approach to this and really encourage all voices and perspectives on how to create really genuine economic opportunity for low-wealth families. It's a pleasure to introduce Paul today. We're really fortunate to have him here as our speaker, especially because this issue has such consequences for people today in California. He is a national expert on how lending policy and practice impact low-wealth households. Currently, he leads the California operations of the Center for Responsible Lending. CRL is a nonprofit, nonpartisan policy organization that is dedicated to protecting homeownership and family wealth by working to eliminate abusive financial practices. Prior to leading CRL, Paul held leadership positions as an appointee at the federal and the county level for HUD and at Alameda County. And before that, he led work at the Center on Budget and Policy Priorities in Washington, D.C. So I'm going to let him jump right into his work, and I'm sure you're going to enjoy this conversation. Thank you.
Well, welcome, and thank you all for taking the time to attend this event, and thank you especially to the New America Foundation for hosting this forum on this critically important issue. I'm gonna jump right in, if I might. First, a little bit more about the Center for Responsible Lending. We have been around since about 2002. We're based in Durham, North Carolina. Have opened our office here in California last year. We also have a large office in Washington, D.C. Pull this back a little bit here. We are in the middle of these conversations and policy discussions at the federal level, with respect to federal regulatory matters and federal legislative efforts, of which there are many. And we are involved in legislative battles and discussions in many states all across the country. Importantly, CRL is an affiliate of Self-Help, which is a nonprofit community development lender and credit union. The mission of Self-Help, as you can see, is to create and protect ownership and economic opportunity for people of color, women, rural residents, and low-wealth families and communities. But what that really means is that Self-Help is also a housing lender and a participant in housing mortgage activity at a very significant level. We have provided over $5 billion of financing to some 55,000 low-wealth families, small businesses, and nonprofit organizations in North Carolina and in roughly 47 or 48 states across the country. In our home ownership practice, our loan losses have been less than 1% per year, despite the fact that we, too, are serving and lending resources to borrowers who have less than perfect credit and don't qualify for normal prime rate loans. Today's presentation, I really want to focus on three big points. First point is that California is ground zero for America's foreclosure crisis, and that we're in the middle of right now. And I'll walk you through some of the data to support that contention in just a bit. The second is that the mortgage system for originating loans in the subprime sector is really broken, and that a market forces alone won't fix the problems that have gotten us to the mess that we're in today. And third, to really fix the problem, we need both state and federal action to address the variety of problems that are out there and need to be addressed. So I want to start a little bit at the basics. I'm sorry if I insult you all, but it's often the question that doesn't have a particularly easy answer of, well, what is subprime lending? And there is no widely agreed upon definition exactly of what subprime lending, but for our purposes today, it's really simply higher cost loans that are provided to borrowers with imperfect credit as a risk adjustment, and to borrowers who are borrowing more than they can otherwise afford. And essentially, subprime loan refers to the credit quality of the borrower, not to the interest rate. And in fact, the interest rate, it's a total misnomer. The interest rate is there's an interest rate premium on loans going to subprime borrowers. So first is, what's the state of the foreclosure epidemic today? First off, and I'll just walk through a few slides here that have a fair amount of data. Around foreclosure specifically, there is no perfect data. There are three widely cited sources of data in the media, maybe three or four, and I won't pretend to cover them all here, but since we read about them all, I think it's worth highlighting some of the key findings from each of them. The data that's collected are collected from county recorders' offices. And so DataQuick, RealtyTrack, the Mortgage Brokers Association is slightly different, Mortgage Bankers Association is slightly different, but they're collecting data from what is already currently disaggregated data. So DataQuick is one of the big companies that's been releasing these data. And the important point for all of these data is that they're all telling the same story. And the story is simply that we are already experiencing record levels of foreclosures here in California, and more importantly, that this problem is likely to get much worse before it gets better unless there is some significant policy change. So the DataQuick data, first quickly, in the third quarter of 2007, 24,000 completed foreclosures, which is up 40% from what was already a record level of completed foreclosures in the second quarter of this year, and up some 600% from the same time last year. Now, of particular concern is that the geography of foreclosures is not equal across the entire state. Half of the default notices that were issued are found in 293 zip codes out of a total of something like 1,600 zip codes throughout the state. And these foreclosures tend to be concentrated in what I call the crescent of foreclosures, which starts here in Sacramento, runs down through the Central Valley, down to the Inland Empire, and out to the coast with LA and San Diego bearing substantially high levels of foreclosures activities. And a second point of great concern with DataQuick data is that, unlike earlier in the year, when the foreclosure process is a long and complicated process that starts with a notice of default. And I'm not going to walk through all the process at this point in time. The fact of the matter is that many homeowners that fall into delinquency or get a notice of default will correct their problem without any concern and without losing their homes. DataQuick recently reported in the third quarter that as opposed to the 80% of folks who were correcting their foreclosures after entering the process, I believe this was last year, now the number is down to fewer than half, or 46%. So people are not able to correct the foreclosure process on their own without some additional change. The second source of data, which is probably the most commonly cited data in the media, are realty tract data. They collect data for every metropolitan area in the state. Their data is a little bit problematic because they collect data on every action having to do with every foreclosure that's taken. So they will report on a notice of default and the initiation of a foreclosure process and the completion of a foreclosure process. Anytime there is a record filed with a local county recorder, they will report that as one action. But again, the story is clear. California has the third highest foreclosure rate per household of any state in the country. And California metro areas predominate the national standings for these foreclosure measures based on a per household basis. As you can see here, Stockton, Riverside, Sacramento, Bakersfield. Oakland is the new entrant on this list on their most recent report. And so that's a cause of some concern. Again, I think these numbers flop around a little bit. Usually we've seen Merced and Fresno and other places in the Central Valley show up on these numbers. Riverside and San Bernardino are also noted here because they have the two of the three highest rankings in the absolute number of foreclosure filings, not adjusted on a per household basis, simply because of the size and the size of the population and the magnitude of the problems in those communities. Finally, my organization has done a number of analyses of this problem. Last week we published a report where we estimated the number of foreclosures that would result from the metro area data for subprime loans originated in 2005 and 2006 at 180,000 altogether. More than 1 of 5 households in California that received a subprime loan in 2005 and 2006 are projected to end in losing their home, a completed foreclosure. That number amounts to about a little less than 500,000 for all loans that were subprime loans that were originated between 1998 and 2006. And then finally, the data point that I really want to highlight is the foreclosure problem is very much a subprime problem. In the second quarter of this year, according to the Mortgage Bankers Association, subprime loans represented about 15% of all of the loans that were in circulation in California, but they represented 68% of all of the foreclosure starts that were reported to the Mortgage Bankers Association. One of the common things that we hear when we're doing this work, again, Self-Help is a subprime lender. We are a responsible, sustainable subprime lender, and we continue to believe in the importance of having a sustainable and responsible market for the provision of credit to people who have less than perfect credit ratings. But one of the things that you hear from time to time is that, well, we don't want to do anything to curtail or limit or provide tighter regulations in the subprime market because you'll reduce access to credit. And when we wanted to sort of look at this, and what we did was we looked at the amount of subprime lending that was going to new homeowners, that is, homeowners purchasing their first home. And we compared that to the number of foreclosures that would come from subprime lending, both for refinance lending, which has traditionally been the source of most subprime lending, as well as for homeownership lending. And what we found over the period of 1998 to 2006, the blue lines here, the blue bars, represent the number of new homeowners. New homeowners. And so when we think about it, subprime loans are primarily are being used for refinance loans. In California, the numbers have sort of evened out, all told, 50-50 between refinance and new home purchase loans. But of those that are going to new homeowners for the first time, the blue lines are represented here. The green lines are the total numbers of foreclosures, both for purchase and refinance loans. Bottom line is that subprime lending overall between 1998 and 2006 will result in a net loss of 175,000 households in California owning their own homes. As I said last week, we put out a big report that the subprime problem is not one that merely focuses on the borrowers who have subprime loans. The consequences of subprime lending extend far beyond. We did an effort to kind of quantify that based on a well-regarded academic study that found that for every foreclosure in a neighborhood, that houses in close proximity, 1/8 of a mile to that household, experienced a 0.9% decline in their housing cost for each foreclosure. So we looked at that statewide and realized that some 8.4 million households will be experiencing lower housing equity value, not because they've fallen behind on their mortgages, but because their neighbors have, or that their neighbors are actually experiencing foreclosures. So the costs of foreclosures are not limited to the borrowers who are losing their homes. We estimated a total loss of about $67.2 billion in the loss of value associated with foreclosure costs to the neighboring impacts of foreclosure costs. Other consequences we've already seen about in the last few weeks. Economic slowdown. The Milken Institute economists are now projecting that the housing slump will send us into a recession. Others simply say, the Anderson forecast in UCLA is saying it will be a major drag, and unless something else happens, we won't tip into recession. But it's clear, the reports are clear, there is an economic slowdown associated with the housing decline in the housing construction sector and in consumer spending. Because whether we like it or not, people have often been refinancing their homes in order to take out equity and use that to bolster their consumer spending all along. Finally, there's a decline in state and local tax revenues. And most importantly, in some respects, again, these are happening in concentrated neighborhoods. And where you have concentrations of foreclosures happening, you have houses that stand vacant, you have decline in neighborhood conditions that, again, accelerate the price declines in those neighborhoods and impose additional costs on local governments to try and address them. As I stated at the outset, this problem will get worse before it gets better. That's because the projections on a month-by-month basis of the number of subprime adjustable rate mortgages that are coming up for their first reset will grow over the course of 2008. We have not yet begun to see the peak levels of resets that are going to be occurring, with an absolute peak occurring out in October of next year, but with extremely high levels occurring in next spring, March, April, May, and June are the top bars on this. Another important fact about the subprime lending is that it's disproportionately targeted. Minorities are disproportionately receiving higher cost loans. We see here in this figure that roughly 4 of 10 African American mortgage loans are high cost loans. Similarly, 4 of 10 loans to Latino borrowers in California are high cost loans. In 2006, it's roughly double the percentage that are going to white borrowers. CRL also did a study last year which found many people who look at these data say, well, of course, the simple reporting of high-cost loans doesn't address the fact that minorities may have less good credit quality than white households on a systematic basis. We were able to take some data and look at credit scores and loan-to-value ratios, and even after controlling for the differences in credit quality, we still found that African American and Latino borrowers were more than 30% likely to receive a higher rate loan than white borrowers who had essentially the same credit qualifications. Finally, on the data front, as much as we would like things to be getting better, the recent projections are not very encouraging. A range of really stunning figures that I thought I would share with you. HUD Secretary Alphonso Jackson, about a month ago, estimated that 25% of all loans coming up for their reset point would end in foreclosure. First American CoreLogic said that up to 50%. Really a stunning figure if you think about it. And then finally, there are certainly, and while obviously economists differ, Goldman Sachs came out just a few weeks ago with an estimate that said that California home prices are overvalued by a total of 35 to 40%. So the declines that we have seen in certain places in California are just the beginning. And again, am I going to bet money that it's going to be a 35 or 40% correction for California statewide? No. But I think it is a credible source that says this problem of declining housing prices is going to be with us for a while and is going to be immune to really quick fixes. Okay, so part two of this presentation is to talk a little bit about and to inform you a little bit about how the subprime market works, what the products that have been provided in the subprime market are, and to reinforce the point that the market alone won't fix the problems that we have seen. So to do this, I have this very cute little presentation. If you think back 20 or 30 years ago, I describe here the features of what I call my mother's mortgage market. These were the good old days of mortgage lending, where the standard product was a 30-year fixed-rate loan. Underwriting took a long time. You had to collect and bring in your papers, and it got made by an individual loan officer. The lenders who were making you these loans were banks and most frequently local savings and loans, who held those loans on their books until they were paid off. The profits for the good old mortgage business used to be made on the interest spread between what lenders would pay out as interest on their deposits and what they would collect in interest payments from their mortgages. And we had the good old days of the challenge of serving the underserved were really about redlining. We're about getting borrowers to say yes to borrowers who lived in low-income communities or who were often borrowers of color. A well-documented phenomenon, and you know, and this wasn't so long ago. Wasn't so long ago. I served in the U.S. Department of Housing and Urban Development in the mid-1990s, and when I was there, our major focus at that time was on redlining, was making credit accessible and available to low-income communities who were dying to become homeowners. Dying to become homeowners. Well, how far we have come. The pendulum has clearly swung to what I describe here as the 21st century subprime mortgage market, which I would note really is the 21st century subprime market as circa 2006, because the market is clearly in some state of flux and change, and we don't know where it's going. But for most of this century, you've had a dramatically growing subprime market that has been marked by very contrasting features from my mom's mortgage market. The products that are offered have a huge array of options. Interest-only loans and option arms and stated income loans and multiple features and multiple ways of making these loans, quote, affordable to borrowers who are struggling to get into the mortgage market. You have underwriting that's done with a heavy use of technology and a heavy reliance on credit scores, so that the decisions can be made almost instantaneously. The lenders, particularly in the subprime market, are overwhelmingly non-depository, non-bank institutions, private mortgage companies whose names you've heard of, I'm sure, or at least whose names you used to hear of, Ameriquest and New Century and Option One, a whole lot of large, mostly non-depository lenders. and that most of the loans in the subprime market are originated not by the retail employees of those companies, but by independent brokers. And the lenders who are getting those loans, rather than holding them on their books, are simply making the loans and selling them to Wall Street firms who are packaging up these loans and selling them off as securities into global capital markets. The profits from these loans are generated not from that archaic notion of interest rate spread, but often by simply generating volume of transactions and the fees associated with that. And the problems of the underserved are no longer about getting access to credit. There was a fairly widely held joke in the industry that described the subprime mortgage market as if you could fog a mirror, you could get a loan. And the issues around access to credit, the pendulum has swung to the other extreme, where pretty much anybody could access a loan. The real questions were about what you're going to pay for that loan and what are the terms and conditions that are associated with that loan. Oh, a few more facts. There's too many facts. I've covered some of these already. Historically, the problems in the subprime market used to be primarily a refinance market. Because of California's high housing costs, the pressure to move into the subprime market has led to more subprime loans being used for purchasing their homes. It's now about 50-50, but still only about 10% of loans are being used for first home owners, not people who are trading up to their second or their third home. As I mentioned, heavily broker originated. What I didn't mention, I mentioned in passing that the subprime loans in California have been predominantly those that have been originated by the non-depository institutions. So they're regulated, theoretically they're regulated by a combination of the state and the Federal Department of Housing and Urban Development. But that's an important point. It's not the banks. The main national banks like Wells Fargo and Bank of America have not been the primary lenders and the primary culprits of this problem. The primary culprits of this problem have been the independent, non-depository mortgage companies that have been originating these loans. And as I mentioned, in California over the next 18 months, we expect up to 500,000 loans will be reaching their first resets. Characteristics of the 2006 cohort of loans that were made. And 2006 is a really important year. It's the year that the sort of standards in the subprime lending market really, by pretty much all accounts, really got loosened to the point of becoming extremely, extremely dangerous. But in 2006, we found that 70 to 80% of loans in the subprime market are what we call exploding ARMs. Now, everybody knows what an ARM is, an adjustable rate mortgage. The standard product in the subprime market is a hybrid ARM where the loan term is fixed for usually 2 years, sometimes 3 years. They're frequently called a 228 loan. There is extremely aggressive underwriting to get people into that loan at the outset, so that at the initial payment, they're paying, they were underwritten assuming that they were paying 50 to 55% of their gross income for their mortgage costs. And then after 2 years, or sometimes 3 years, there's a very large, by design, jump in their mortgage payment, on the order of 30 to 40% on average. And remember, the original terms of these loans were underwritten not based on the amount of the increased payment in month 25 or month 37. They were underwritten with very aggressive assumptions to be paying their initial payment, even though the loan was going to be going up by 25, 30, 40% at month 25. That was a loan that was created, described as providing an access into the mortgage marketplace. But what in reality was happening is that these loans were designed to be refinanced before month 25. I don't think anybody really expected folks to be repaying at the higher rates that people are facing now, and that was possible because California's housing market was growing by an order of 10, 15, 20% a year, all throughout the early 2000s, 2002, 2003, 2004. And as long as you're having growth, housing price appreciation, borrowers could afford to refinance based on their growing appreciation, regardless of what's actually happening with their income. When the housing market starts to slow down or prices start to decline, that structure clearly doesn't make much sense. And that's really the sort of, in a nutshell, the problem that we're seeing today. Second feature that we see in subprime loans here in California, about 50% of them are stated income loans. Meaning rather than getting loans where the borrower is providing income tax or bank statements to document their actual income, the borrowers and the brokers are agreeing to state their income without any independent income verification, verifying what the borrower's actual income really is. So 50% of loans being made on a stated income basis. 75% of subprime loans don't have an impoundment account or an escrow account, so that as borrowers are expected to be paying 50% of their gross income for their housing costs, they're also going to when they're making their mortgage payment, at least like I do, they're not making a payment for their taxes and their insurance. They're supposed to be saving money separately on the side to account for that. Again, that's about exactly opposite in the prime market, where about 3/4 of prime borrowers have impoundment accounts when they pay their mortgage payments. You had a huge development in the 2000s with piggyback loans, with soft second loans, which allowed you to do no down payment loans and to avoid mortgage insurance and not put down a down payment. And finally, most subprime loans here in California, about 80% of them, have prepayment penalties. So that even if you take out your loan, you know that you're going to have to refinance it within 2 years, most prepayment penalties run coterminous with that first fixed term of the fixed rates. So that if you refinance before the 2 years is up, you're going to pay 6 months of interest payments to be able to get out and refinance that loan, even if you're qualified and want to refinance into a prime loan. So you're losing substantial amounts of equity with each refinance transaction. Again, 80% of subprime borrowers have prepayment penalties. About 3% of prime borrowers have prepayment penalties on their loans. All right. So part of the problem here, and a big part of the problem here, is the system in which we have set up to originate these loans. And I would argue that we have a system that's set up that builds in incentives that are going to lead to bad outcomes for borrowers. We have a system where brokers are originating most subprime loans, and brokers are receiving payments from lenders for putting borrowers into higher rate loans. Now, why would they be doing that? This goes back to the structure of the marketplace today, where secondary markets, the bondholders overseas are craving higher rate returns in their securities. So Wall Street firms are looking to package individual mortgages into securities that have higher interest rates. So Wall Street firms are paying lenders a premium for loans that have higher interest rates. So lenders are paying brokers to originate loans with higher interest rates. The folks who get left out of this deal are the borrowers. Many borrowers don't know that the interest rate is an interest rate that they can negotiate with their broker over. They take it on trust that their broker, who by common law is required to serve as a fiduciary to them, they take it on trust that their broker is going to represent their best interests and get them the best loan. You can see these broker kickbacks on the rate sheets that are provided from the lenders to the wholesale brokers that are out there. Now, unfortunately, the borrowers don't get to see the rate sheet, so they don't really know the full range of the products which they might be eligible for, and they don't really know that brokers are getting this payment, extra payment for putting them in a higher rate loan. I also mentioned prepayment penalties. As I said, one of the prepayment penalties and the yield spread premiums are connected, because if the lender is paying the broker a premium of a percentage point, a 1-point premium to the broker for bringing in a loan at a half of a percentage point higher than the best loan for the best rate which the borrower could qualify, well, the lender wants to make sure that that borrower isn't going to prepay their loan too quickly. So in most cases, the lenders wouldn't allow subprime loans that are being paid, where they're paying a yield spread premium to be made without a prepayment penalty. So the lenders want to lock in 2 years' worth of revenues, and if they're going to get out of it beforehand, they're going to collect a prepayment penalty in advance. And then finally, the facts are that if you look at the data and you look at the qualifications of borrowers, subprime borrowers who have gotten subprime loans, there are a variety of studies out there. Nobody's absolutely sure. But because of these financial incentives, we believe that the estimates range from 20 to 40% of borrowers could qualify for a prime loan and are yet steered to a subprime loan because, in fact, that's where the money is. Current market structure, as I mentioned in brief, lacks accountability. You have a system here where brokers are originating most of the loans but don't have long-term liability for them. They are paid up front when the loans are originated. They don't bear any long-term consequences if the loans go bad in the future. Similarly, the lenders are making money based on volume transactions. They make their loans and instantaneously sell them to Wall Street packaging these loans up into securities. The ratings agencies are supposed to be rating these securities, and somehow many of these securities came out of this ratings process with AAA ratings, despite the fact that every single note in them was a subprime high-risk loan. Investors all over the world are buying these loans based primarily on the diligence of the ratings agencies and their ratings. The investors in capital markets certainly can't investigate or read through the hundreds and hundreds of pages in the prospectuses that are going along with these. And then we have the servicers who are collecting and who essentially are the front lines now. On a fee-for-service basis, they're the ones who are managing these loans going forward. In short, there has been for those who argue that the market itself will correct this, there has been little evidence to suggest that that's going to be enough to correct the nature of the problem. First of all, I should say that the performance of 2000 loans and 2000 securities has been just as bad, if not worse than, the 2006 performance. And that's after the problems in the subprime market nationally came to light. There clearly has been some tightening of underwriting criteria. The availability of high LTV, no down payment, stated income loans, much tighter to get. Much tighter to get. But there haven't been changes in the underlying system, in the incentives that brokers face, in the occurrence of prepayment penalties in subprime loans. And our concern is that with the uptick of a housing market, whenever that is, 3, 4, 5 years down the road, that the lure of greater profits will entice many of the same players that we've seen capitalize quite handsomely back into some of the practices that have created this problem. In short, we think that this crisis has occurred because of a lack of adequate regulation and structure at both the federal level and at the state level, and we need to have some changes in the regulatory process to make sure that this doesn't happen again. So what do we need to have happen? Well, we think that both state and federal action are needed, and we divide it up into two sets of issues. One is we need some things to try and figure out how we can help current borrowers who are sitting out there in loans, facing rate resets without the economic ability to repay those loans. And secondly, we need to change the regulatory structure to build in what is essentially a return to responsible lending standards, and to try and swing that pendulum back more towards the middle, where you can provide access to long-term, sustainable, affordable homeownership credit, but that builds in a certain level of protections for borrowers in the complex mortgage marketplace that we're in today. So first off, I want to walk through what the state should be doing. Many of you may have seen we had an op-ed in the LA Times on Friday. At the heart of efforts to help current borrowers, I think the problems of helping current borrowers need to be addressed, and they need to be addressed immediately. We can't afford to wait for the normal legislative order to try and put in place a fix that won't take effect until January of 2009. Too many borrowers facing resets will be left out in the cold without any assistance. The absolute best strategy, it seems to me, for addressing the problems of current borrowers is one that focuses on restructuring the existing loans in which borrowers are in. Remember, these loans were made on a fixed rate basis, and the initial interest rates for these 228 loans, they were risk-adjusted loans. These aren't the 1%, 2% prime option arms that you read about. In general, they were 7%, 8% above prime when they were originated, and providing a modest profit to existing lenders and investors. The best approach that has been we believe, is the approach that has been put forward and championed by the chairwoman of the FDIC, Sheila Bair. And she's basically said and called for the lender servicers who are controlling these loans to sort of get on with it. And what she means by that is we should basically, for borrowers who are current with their mortgage payment at the time the mortgage resets, we should lock in their initial interest rate and convert it to a 30-year fixed or to a fixed rate loan for the remaining term of that loan. It has dramatic benefits. It's easy, it's straightforward, it reduces the costs imposed upon lenders and servicers who are involved in trying to contact and work on a one-by-one basis to negotiate loan modifications today. And more importantly, despite the economic benefits of this, which allow loans to continue to perform, avoid much more expensive foreclosures. Foreclosures, on average, the costs of foreclosures range from $50,000 to $80,000 per foreclosure. And providing some revenue flow from these loans at the existing initial rate is a far better outcome. Now, to date, many lenders have talked about their new practices. They've been staffing up. They've been taking on new practices to reach out to lenders or to borrowers before their loans reset. But unfortunately, for a variety of reasons, those efforts have not yet panned out into actually helping many borrowers to stay in their homes. Moody's did a survey about a month ago of the 80% of the servicers who control 80% of the subprime market. They found that only 1% of loans at reset were getting modified. Right now, the system is also very labor intensive. It's on a one-by-one basis. It actually reminds me of the way mortgages used to be originated 20 years ago, done on a one-by-one negotiated basis with an individual person making the decision, taking a long time. I met with some housing counselors last month who complained that they were getting modification packages submitted to lenders and weren't getting word back for 120 days. And in some cases, lenders were starting to foreclose while they had a modification package before the loss mitigation team, for where the left hand didn't know what the right hand was doing. Again, I think the most important challenge here is getting some streamlined process in place that's going to take the modification process from a one-by-one, labor-intensive, negotiated retail process to a wholesale basis, where it can happen quickly, efficiently, not disrupt families and the lives of families, and most importantly, avoid much wider spread foreclosures. Right now, we don't have any transparency in the system. It's done on a one-by-one basis. We don't know. They're equally positioned borrowers may be getting wildly different outcomes depending on who they talk to, whether they have a loan counselor or not, and so forth. And most importantly, in some respects, is that there isn't any generally accepted data around to track what's actually happening in the marketplace when it comes to these modifications. On that score, I want to commend the Department of Corporations here in the state of California that has begun to collect some of this data from the servicers. It has the promise of really shedding light on what's actually happening in the marketplace. Hopefully, the Department of Corporations will be providing that data publicly available, hopefully on a lender-by-lender basis, so that we can actually see where the rhetoric of increased effort is translating into the reality of people saving their homes. The other short-term immediate priority is that the state should come up with a $10 million appropriation for emergency foreclosure prevention counseling and legal assistance, because borrowers are, this is a complex world. The possibility of having an intermediary who is informed about how these mortgage processes work has been proven to be effective in helping borrowers, and for some inexplicable reason, HUD has reduced funding for housing counseling. It's traditionally a federal responsibility. They've reduced the funding available from $3 million to $2 million, despite what is a tsunami of foreclosures that we're facing today. So I think that either if there are not existing funds available within the administration, that there should be an emergency appropriation put out on an expedited basis through some agency of the California government. I'm not sure which one, probably HCD, but that will get money out to the housing counseling agencies and legal service providers who are on the front lines trying to provide some intermediary services for borrowers. The second piece for California is that, like a number of other states, there's a desperate need to tighten up the basic regulatory framework that governs subprime lending, especially the state-regulated subprime lending entities. We group this into three basic categories. The first is, as I've mentioned, a return to common sense lending principles, and that we should codify some of the provisions, codify and make sure that we enforce some of the provisions that were included in federal regulatory guidance and that should be being adopted by the Department of Corporations. But things like making sure that every borrower there's an analysis done of their ability to repay, that income is verified, and while we are sensitive that not everybody is going to have all of their income appear on a W-2 form, that there are a variety of mechanisms, including payment of rent on an apartment, or even remittance statements and bank statements, payment of utilities that can be used to verify the income that borrowers say that they have. And finally, subprime borrowers should be required to set aside, establish an impoundment account for their taxes and their insurance. With respect to the second big provision is aligning the incentives with borrower needs. And for that, we would simply be much more directed and controlling and say that brokers shouldn't be provided financial incentives to put borrowers into higher rate loans. And we would essentially ban yield spread premiums and ban prepayment penalties. Prepayment penalties have been banned in 10 states across the country, restricted in, I think, 37 altogether. Yield spread premiums, the proposal for yield spread premiums follows a provision that was originally introduced in federal legislation, although its current status, it was weakened in the final consideration on the House floor last week. And finally, we would simply put in an outright ban on steering, and that is that if you qualify for a prime loan, you should get a prime loan. Shouldn't be steered off to a subprime loan. The third piece is that we really need to change the system of accountability. Right now, there's a system of where there's a lot of finger pointing, and ultimately, the way the system has worked to date is that it's sort of been a game of risk hot potato, that you make the loan and you pass it along or you sell it along and you sell along all the risk associated with it. We need sort of overlapping responsibilities for the origination of these loans. And so our answers to that would be, first of all, to establish a strong and enforceable fiduciary duty into code. Currently, that's in current law. Brokers should have a substantial bonding requirement because right now the brokers don't have any substantial capital invested or at risk in this process. We believe lenders should be liable for all loans that are originated, not just the loans that are originated directly by their retail representatives, but they should have a higher level of liability and responsibility for the errors and the omissions of brokers. And finally, we need to develop assignee liability, which simply means that the risks associated with the loans can be enforced on the folks who are buying the loans upstream. That's Wall Street firms, that's global capital market investors. Now, this isn't to penalize those folks. This is to make them adopt more rigorous market incentives to be more conscious of the standards of the loans that they're buying. Right now, they don't have to worry about it. We're saying they should have to worry about it, and the way they're going to worry about it is if they can ultimately be held liable for bad loans. At the federal level, there are a number of important provisions. Perhaps the most important one is a bill that is going to be marked up in the House and heard in the Senate in the next few weeks that would fix a quirk of the bankruptcy code. Chapter 13 of bankruptcy, if you're doing a workout as opposed to a liquidation bankruptcy, the only asset that a bankruptcy judge doesn't have the power to rework the structure of is the primary residence. It's the only asset. The judge can rework the asset of your mobile home, of your big cruise ship, of your second home or your third home, but they can't rework the fundamental modification of the mortgage contract for your primary loan, and we think that should change. We're not alone. Mark Zandi, prominent economist, economies.com, agrees. We think that could save up to 500,000 people their homes. A second provision is tax forgiveness. Another quirk of the federal tax code is that if you are given a principal write-down in the context of negotiating with your lender, that principal write-down can be counted as income and you have to pay taxes on it. It's crazy. It is crazy. I mean, you can write off you don't have to pay taxes on your first $500,000 of capital gains on your primary residence. But if a lender wants to forgive $20,000 in principal because you got into a loan that you can't afford to repay, you have to pay taxes on it. It just doesn't make any sense. That's a provision that is being moved forward on a bipartisan basis through the Congress at this point. I think there's also a potential larger role for the FHA and for the Fannie Mae and Freddie Mac, who are exploring a variety of fixes. Well, there's a combination of recent and upcoming federal action that is expected. Just to wrap up, first of all, the Federal Reserve has said that they are going to be putting forward new regulations sometime before the end of the year that are going to govern all the activities of all mortgage originators. They have that power as given to them by Congress to define what are unfair or deceptive practices in the mortgage market and apply them mortgage market wide. We have no idea what those are going to look like yet, but they could go, if strong, could go a long way to solving some of these problems. Comprehensive predatory lending legislation has been a hotbed issue in the Congress this year. There have been innumerable hearings on this. Legislation was passed on a bipartisan basis. H.R. 3915 originated by Chairman Barney Frank of the House Financial Services Committee with the endorsement of Spencer Baucus, the ranking minority on that committee. That bill provides some very strong protections. It also raises some serious questions about how effective the remedies and enforcement mechanisms are going to be in ensuring that those protections actually get delivered in the marketplace. The bill will be moving to the Senate, where Senate Banking Chair Chris Dodd is expected to introduce a new bill sometime in the next few weeks. All told, I think the bottom line at the federal front is there's still a huge amount of uncertainty. I think it's probably 50-50 at best as to whether or not in the short run we will see any major predatory lending legislation get passed through Congress by the end of next year. We don't know what the federal regulations are going to look like. And that's my contact information. I'll stop there. Thank you for your attention. Look forward to fielding any questions and answers. Olivia, what's the plan for fielding questions? Does anybody have any questions? Sir. Could you identify yourself?
I'm Tim Reese, Director of the California Nevada Community Action Partnership. We represent providers to low-income communities services. And the issue that concerns me is the practice of home builders using their own mortgage company to finance the sale of homes. So they've made money on the sale, they've made money on the financing, and they've walked away. That concerns me greatly.
It's a growing problem. I mean, we've heard reports of that in various communities across the country. Did everybody hear the question? Yeah, okay. Of builder financed, housing developers financing their own mortgages. And that's a concern. Again, I think that it may be less of a concern if there are adequate protections in place governing all loans and all transactions. You're going to correct some of those problems. But right now, that only adds to the problems because obviously those builder developers have a great incentive to sell their homes. Other questions? Here and then there.
Al Kadani from Majority Leader Karen Bass's office. How do you account for the speculators, a lot of the investors who came in as signed the owner-occupied, but in fact they were non-owner-occupied to benefit from the interest rate adjustment, at risk of bailing them out or helping them out because they were just playing the market? Right. How do you separate the wheat from the chaff?
So the question was, should we be dealing separately from investors versus owner-occupied provisions? Chairwoman Baer has specifically identified that relief would only be provided to owner-occupied, and so I think what that means, as you mentioned, Awet, that many times there is maybe mortgage fraud committed to the extent that investors are applying for loans as owner-occupied. That obviously, I assume, would be illegal to do. So I think that there are ways of verifying whether or not the loan that's being modified would actually be owner-occupied, simply by in some cases by doing a cross-check to see whether or not one owner owns multiple residences. That would be one way, and folks are looking at that. The one other thing that I would say, I think there is certainly a lot of sort of moral concern about providing a, quote, bailout to investors. From an economic perspective, however, the fact is a foreclosure is a foreclosure is a foreclosure. And to the extent that it results in a vacant property in a community, it's going to have the same economic impact. Again, I'm not arguing whether you should or you shouldn't, but simply to point out that the economic rationale for providing something that will allow that property to continue to keep paying and avoid foreclosure you have to take that into account when also considering what to do about whether you actually want to provide some sort of relief for those kinds of investor properties. Oh, wait, I'm sorry. Here and then there.
Paul, I just learned this morning that some lenders are steering the borrowers to short sales and then telling them that we'll do it for 3 months. If it doesn't sell, we'll let you keep it for another 3 months. And then maybe we'll renegotiate with you, you purchasing at what the current value is.
Could be. I think that there's a lot of different things that are happening out in the marketplace today. There is no consistency. There's little transparency. So you get a lot of questions, even talking to housing counselors who are dealing with this on a day in and day out basis, who say, I'm seeing this or I'm hearing that. And there's just, it's hard to really make sense of it because there isn't any sort of public accountability for the loan servicing piece of this. Sir, and then back here.
I'm Pablo Garza with Senator Dean Flores' office, and I'm kind of building on this question asked over here. You referenced Chairwoman Baer's comments about freezing the introductory rates, and my question is who has in the jurisdiction as a regulatory entity to do such a thing? I mean, was that the FDIC, or can the state do that? Or?
Well, no. I mean, if the FDIC could do it, they would. That she has. It's a bit of the quandary that we're in right now. You have this. This old thing called the Constitution, which establishes the basic rules of the game with regards to contracts, with regards to takings, and so there isn't. It's not entirely. It's not. Certainly, there are no straightforward ways of compelling the lenders and servicers to do that. And so, while it is it should be in the economic interests of all parties involved, the state, investors, lenders, servicers, borrowers, to come up with a modification. They haven't been doing that for a variety of reasons. We don't know of any immediate way that anybody can compel them to do that, because the vast majority of these contracts were legal contracts that were exercised knowingly. Now, clearly, there's some degree of fraud, and there are some that, on a case-by-case basis, there are some problems. But on a systematic basis, the challenge is figuring out what's the right pressure that will change the behavior of these lenders more on a voluntary basis than on a required basis.
Les Spahn, Assemblymember Randall's office. On your current market structure, you have brokers, lenders, Wall Street rating agencies, investor servicers. And servicers seem to be a focal point here in terms of dealing with this issue. Who are these servicers? Who are they working for? Who's paying them? And who regulates them here in the state level?
Servicers tend to be big lenders. They're operating on a fee-for-service basis from the trustees. They're the big ones are Countrywide, Wells Fargo. I don't want to leave anybody out, should I? Chase. Absolutely, yeah, absolutely. They tend to be the big lenders, and they tend to be depositories. There are no explicit regulatory requirements around the servicing activities of these lenders. They are essentially all licensed by one body or another here in the state, but I don't think there's anybody who has an explicit regulatory regime or audit examination process of their activities for the purposes of servicing the loans. Correct. They are regulated for the purposes of originating loans, but not necessarily their servicing activities. Correct. Correct. I had this question first, and then we can come back to you.
In 2004 and 2005, this activity was really bubbling up. The market was hot. The press, widely described stated income loans as liar's loans.
Not widely enough.
Well, but it was pretty much out there. You pick up the Wall Street Journal or other financial publications, you would see that. Have the Wall Street firms and the investors, have they rethought requiring the brokers to have some skin in the game to protect themselves against what was essentially in many cases open-eyed fraud?
No.
Why not?
Well, there's a few reasons. One, at the federal level, they're calling for essentially a national registry for brokers that will require all states to meet a certain standard in registering and licensing their brokers, but there is no minimum required bonding requirement or anything like that. They just say they're independent contractors. They're independent contractors who are working for and providing lending activities for many different lenders. Let me go back I want to go back 1 second about the issue of compulsion. The thing that I think can make the most difference at this point in time with respect to driving modifications is a very high-level political consensus to put pressure on these very large lenders to act in their own economic interests and in the interests of the state to avoid the disastrous economic consequences that are lurking out there in the future. And that's the first part. And the second part is to then follow that up with monthly data, tracking their accountability and their performance in doing what they say they're going to do. Not a compulsion. It isn't a guaranteed home run, but as I look at the picture, when you have agreement between the New York Times and the Wall Street Journal and the FDIC and the Federal Reserve Board, you know, there needs to be sort of a growing political momentum about that will pressure those to get those kinds of outcomes, and then enforced by data, because we've seen the rhetoric to date, and the rhetoric hasn't met with the reality. We need the data to make sure they do what they say they're going to do. Last question right here. Sorry, Michael, you had yours.
How much of the blame should the rating agencies take, Moody's, Fitch's, et cetera, and should there be some sort of regulation placed upon them to force them to pay more attention to this?
Well, my view is that there's plenty of blame to go around, up and down the entire mortgage origination food chain. I'm not one that believes that every single borrower is working wasn't taking advantage of a system in a way that they shouldn't have been. The brokers, the lenders, I think everybody in this food chain has some responsibility, and the ratings agencies are among them. And we've seen that the ratings agencies have been a weak link in providing essentially due diligence for global capital market investors all over, including, I assume, the state of California, which may own some of these securities. So, I think there's blame to go around, and at some level I don't think it's particularly helpful to be blaming one party or the other and assigning blame here and there and everywhere. But I think the real sort of takeaway is we need systemic change, that we can't allow this kind of unfettered open marketplace to continue to operate in the way that it has, putting at risk the largest financial investment of most people's lives, and the access to really building wealth and asset building, which is what this asset building effort is really all about. This is really about asset preservation, and we can't have folks in the marketplace without basic rules of the game that are going to ensure that some basic standard protections are in place. Thank you very much for your time.